Good afternoon and welcome to Biztech's Asian Midday Market Watch. Our guest today is Jeff Halley, Senior Market Analyst, Asia Pacific at OANDA. Jeff, as always, great to have you on the show.
A pleasure, mate, a pleasure.
Now, before we start, let's take a look at the crypto world and see how the cryptocurrencies are performing. Bitcoin is edging up back to the 50,000 mark. It's at 49,380. It's up 4.79%. But Ethereum has been on a run-up and it continues to do so. It's at 3,758.42. It's up 8.7%. Now, looking across regional markets, we've got the Nikkei, which is at 28,517.45. It's up 0.23%. The Shanghai Composite is at 3,586.65. It's up 0.55%. The ASX 200 is at 7,462.2. It's down 0.86%. The Hang Seng is at 26,047.95. It's up 0.08%. The Kospi is down just under 1% at 0.99% at 3,175.39. Bursa Malaysia is at 1,582.43, down 0.28%. Rounding up the numbers, we've got the SGX, which is at 3,078, down 0.31%. What's your view, Jeff, on market performance this morning? Very mixed across the region.
Yeah, look, we've had a reasonably quiet data calendar today, so markets have regionally or nationally been left, to their own devices. So I'm seeing a little bit of position reduction, I would call it, ahead of the non-farm payrolls tomorrow, and I think that reflects what we're seeing in the STI and Kuala Lumpur. The Nikkei has risen after a Bank of Japan committee member came out with some quite dovish comments today, hinting that they could ease further to spur the recovery there. And if we look at South Korea, higher than expected inflation today, which I think the market has taken some umbrage at, putting more Bank of Korea rate hikes on the cards. China is probably the most interesting one. They've called in 11 ride-hailing firms for a meeting today, the government and the Transport Ministry. So another day, another clampdown. That's been reflected in the CSI 300, which has fallen, but the Shanghai Composite, which is really full of more legacy state-owned companies, hasn't moved at all. And when we look at Australia, there's concerns there after some medical establishment people said that the hospital system wasn't equipped to cope with an influx of cases after they ease restrictions. And also the feeling that the trade data today was probably the best that it's going to get, and that the economy could slow quite sharply in Q3, quite obviously because COVID-19 has locked down New South Wales and Victoria. So very much a mixed bag ahead of the non-farms, and I expect that sort of bitsy price action to continue into Europe today as well.
Okay, you've talked about a lot of things. I'm going to zoom in on each one of them. First of all, the event of the week, which is the non-farm payrolls. What is the market expectation of numbers, and what do you think would upset that?
Well, look, the ADP employment number came in much lower than expected last night, and the ISM manufacturing PMI, the employment sub-index, came in very low as well. So companies are struggling to hire workers, and so employment is not climbing as fast as had been hoped. That sort of plays into the dovish tone that Jerome Powell said at the Jackson Hole event, which means that the market's now pricing in a slower taper or a delayed taper, which is obviously going to be good for asset prices. They're expecting 750,000 jobs tomorrow. I think if it comes in on the low side of that, we're going to see another jump in equity prices and the dollar fall. Conversely, if that number surprises everybody, because the market is very much tilted to the risk-seeking side now, if that number comes in around 1 million, we could actually see a sharp correction. We could see equities fall quite quickly as that tapering gets put on the table again and the dollar rise.
And how about Australia now, with the trade surplus of 12.1 billion, but expectations, however, as you correctly pointed out, that we're going to see a slowdown in the final 2 quarters of the year. How is that going to impact Asia, and how is that going to impact the Australian dollar?
Look, the Australian dollar itself, and I'll start with that first, is very much a reflection of the financial market globally's risk appetite. So it tends to not necessarily reflect fundamentals within Australia. And the New Zealand dollar is very much the same. They're used as a proxy for Asia as well, because Asia has a lot of currency restrictions, so it's much easier to trade a correlation trade with the Aussie and the Kiwi. Now, at the moment, the Aussie and the Kiwi are very, very strong, a V-shaped recovery from last week, and that's reflecting that easing of tapering fears and that sort of risk appetite returning to the markets. I think the jury's still out on the performance of Australia in Q3. We've seen before when they've been in lockdowns, it hasn't really materially impacted the economic performance of the country. And I don't think it's really going to impact the export performance. Now, these are things that get dug out of the ground that people melt into things. So that won't be affected. So I think perhaps those fears are overdone. I think what spooked markets today was the Australian medical establishment saying that they weren't prepared or ready or have the capacity to cope with an influx of cases once that 70% vaccination target is reached, and they start opening up and start trying to live with this Delta variant of COVID-19.
The other thing that you brought up, Jeff, which is concerning markets, is the continuing regulatory squeeze in China. After all, the regulators summoned and interviewed 11 ride-hailing firms. Now there's talk that perhaps the next thing that are under their crosshairs is basically the healthcare sectors. Now, what's your view on foreign investors and foreign funds now in terms of them rotating out of China into defensive stock plays?
Yeah, look, I think the actual real winner out of this one so far has been India, to be honest. Now, ASEAN has not received those flows in any sort of meaningful way. They're all struggling, as we all know, with this COVID-19, and it has had a material impact on their recoveries, and those are quite definitely going to be delayed now into 2022. India, for now, seems past the worst of it, and also it's another country of 1.3, 1.4 billion people. It's a logical place for some of that money to head off to. There's also been a lot of IPOs and a lot of action on the equity markets over there as well. So I think that's going to be the real winner. Look, every day we're seeing another clampdown on another sector in China. I can't keep up with them. Now, we've seen a pretty good bounce by the Hang Seng this week. I think investors are still going to try and buy the dip in Chinese stocks, but I don't think we've reached the point where prices are so low that they reflect or offset the regulatory risk. China doesn't do something for 1 month, doesn't do it for 2 months. It does it until it's finished doing it. So we can expect this to be with us. So the danger is that this light at the end of the tunnel that investors keep looking for is actually the train coming the other way. And I think you need to proceed with caution with China equities for the next few months.
Jeff, thanks again for your insights.
Always a pleasure, mate.
Now, we've been speaking to Jeffrey Halley, Senior Market Analyst, Asia Pacific at OANDA on Biztech's Asian Midday Market Watch. I'm Brian Fernandez. This video will be on our Facebook and LinkedIn pages, as well as our website, www.biztech.asia. Please subscribe and like our various platforms. Thanks again for tuning in.